All right, we're going to go ahead and get started. Just a couple of quick things before we go, before I turn it over to Ed. We are recording this webinar so that we can email everybody a copy of the webinar once it's finished. We know you're here. We cannot see your pictures. We have you muted so that we don't have a lot of background noise. But if you have questions or comments, you can feel free to put them in the chat. I will be monitoring that, and I'll let Ed know if we have questions as he's going through the presentation today. I'm Michelle Morris with Consolidated Planning Group, and today we have my friend Ed Batinga. He's a CPA, and he's going to be taking great care of us today. So yeah, like I said, if you have any questions, just put them in the chat. We should finish up right around 1 o'clock. And if you have questions afterwards, we'll have contact information in the email, so you can contact either Ed or I with anything afterwards. So, all right, Ed, take it away.
Right. Thank you, Michelle, very much. Thank you, Consolidated Planning Group, for giving me this opportunity to give this presentation to you guys, talking specifically about some of the tax laws that are currently in place and some of the proposals that are being talked about as we speak, even as recent as a couple of weeks ago. So I'm going to go ahead and get right into this presentation and talk about the content we're going to be discussing today, because I think we have about 6 people online so far.
Yeah.
So basically, the crux of today's presentation is we're going to talk about small business taxes and the Tax Cuts and Jobs Act that were passed by President Trump. Even though he's no longer in office, they are still intact till December 31st, 2025. Although under the current administration, they're looking at adding some stuff and raising some tax rates and things of that nature. That could be announced at the end of the year and voted on at the end of the year, and some of that stuff going into effect January 1st, 2022. And I'll talk about that towards the end of the presentation. Okay. And as Michelle said, if you guys have any of you have any questions throughout the presentation, feel free to chime in during the presentation in the chat box. Michelle, is that correct? And then she'll relay those messages, questions to me, and I'll get those answers as we go along. So just a basic overview of what we're going to talk about today. We'll talk about obviously small business taxes. We're going to talk about business structures, business deductions, and some of the changes of this TCJA, how it affects individuals, how it affects businesses, the big change on this thing called the qualified business income deduction. And it's kind of a tricky calculation. It's kind of tricky. So I put together some examples to hopefully clarify some of it, how it works out. And again, talking about some of the Biden tax proposal that may go into effect at the beginning of next year. So if you're starting a new business, or if you have a business currently, a lot of people ask, what should I do? How should I set this thing up? And I always tell potential clients, to look at setting up a new business in 2 different buckets. There's a legal bucket, there's also a tax bucket, and those have different expectations, different connotations. And so I asked a number of questions, what are you guys trying to do? What are you guys trying to accomplish? And I think another question I always ask, what's kind of your long-term plan? Do you plan on selling it? Do you plan on running it, maybe passing on to your kids? And all those factors are consideration that you should take into consideration when setting up a business. And so some of the key it's really contingent upon how many people own the business. Obviously, if it's multiple people, there's one sort of structure you can look at, how the business will be run, if it's going to be absentee ran, or if you're going to get your hands dirty yourself, and also the types of services and products offered. And really the types of services and products offered, it's kind of contingent upon the potential legal ramifications. And when I say legal ramifications, if you're doing something that has some liability, providing consulting as an engineer or something along those lines, where there is the end product or the end service has potential legal ramifications, that's one thing to consider. And so those considerations are formation costs, which in Texas, it's not as big of a deal as compared to other states, but it is a factor. Liability risk and the pass-through taxation. I'll get into that, the pass-through taxation, as we go along in this presentation. So the main one, the first one that people come to me and ask me about is like, I want to be a sole proprietor. Now, with that being said, again, going back to those key considerations, it is the simple and most common. There's really no formal action that you have to take. You don't have to get any specific registrations with the state, with the IRS and things of that nature. You can just go ahead and get that thing started and start running business. Now, with that being said, with it being as easy as it is, you file this on Schedule C of your tax of your personal tax return. There's not an actual separate tax return in itself. It's part of your individual tax return. Now, again, some of the advantage of this are it's very easy and cheap to form, sometimes little to no costs in the formation costs. Generally one owner, although it can be a husband and wife in the state of Texas. A husband and wife can be considered as one in the state of Texas. And from a tax preparation standpoint on my end, it's pretty fairly easy to prepare. Now, some of the disadvantages are there's unlimited liability. So if you're doing something like an engineering type thing, or being an attorney or a CPA, it's probably not a good idea to be a sole proprietor without getting a legal formation, because you have a lot of unlimited liability. Obviously, the success depends on you. And while this is the most easy and most common from a tax perspective, it's generally not the most conducive to saving taxes. Because of this type of structure, you're subject to self-employment tax. A majority of you at some point in your career have worked for somebody. And when you work for somebody, they take out the employer and the employee portion of Social Security, Medicare tax, and income tax. But when you work for yourself, whether that's a sole proprietor or partnership or even LLC, you have to set aside money for not only income taxes, but you also have to set aside money for employer and employee taxes. And I'll get into that in this next slide. So one thing to consider, especially as being a sole proprietor, you're considered an independent contractor. You may get a 1099 from whoever you're rendering services for, you may not. But in this particular type of setup, you will be considered an independent contractor. And since you are self-employed, you are both the employer and the employee. So like I was saying before, when you work for somebody, they're responsible for the employer portion of taxes, and you're responsible for the employee portion of payroll taxes. And you'll see, when you got something direct deposited into your personal bank account, you get a pay stub and they'll say gross pay of X. This is what we're taking out for Social Security. This is what we're taking for Medicare tax, and this is what we're taking up for income tax. Now, with that being said, that the employer is obligated to pay their portion of it, and you're obligated to pay your portion of it as an employee. But as a self-employed individual, you are now on the hook for both sides. And a lot of times, I pick up a lot of new clients after their first year of being an independent contractor because they didn't understand the self-employment tax aspect of it. And they say, we set aside X amount because this is what we're used to paying, and now we had to pay X more. Why is that? So I have to sit down with them and tell them, explain this concept to them of being both the employer and the employee. Obviously, it makes sense to them because they didn't really understand that aspect of it. But it's one of those things that it's a gotcha kind of things when you're first year doing your tax return. So a lot of people get really surprised their first year. They think they can do this on their own, and they don't realize, oh wow, we didn't realize we were both the employer and the employee in this situation. So that's definitely one thing to consider as being a sole proprietor. Now, with that being said, the total self-employment tax is actually 15.3% and 7.65 on both the employer and the employee side, and the Social Security 6.2 on each side and 1.45. Now, once you get to a threshold of 100, at least for 2021, once you get to a threshold of 142,800, you will no longer be subject to Social Security tax. And on your personal tax return, you will receive a small deduction for the employee portion of self-employment tax, but it's not as significant as people make it out to be. So 142,800, it's gradually gone up every year. It's indexed for inflation. One of the things I'll talk about is under Biden's proposal, him increasing the Social Security base to a significant amount in 2022 that a lot of people don't know yet. That's going to be a potential surprise to a lot of employees as well. So Another entity type to consider is a partnership. And they're, this is a type of entity that's got to be registered at the federal and state level. Okay. It's a flow through entity of income and loss to each partner. If you go back to this slide where I talked about pass through taxation, when I say flow through and pass through, those are one and the same. And so if Michelle and I were to create our own partnership and we made $100,000 at the end of the year, I would report 50,000, and we're a 50-50 partnership. I would report $50,000 of income on my tax return, and she would report $50,000 of income on her tax return. So depending on the equity structure of the partnership, you will be responsible for that percentage of the partnership income loss for that year. Obviously, if there's a loss, you're not paying taxes on that income. The liability is contingent on the type of partnership. The two that you really see are general partnerships, and then in that scenario, all the partners are liable. You generally don't see that type of partnership being set up these days, just because of the unlimited liability. There's also the limited partnership, and only the general partner is liable. Limited partners are generally not liable unless they do something very egregious or criminal activity or something along those lines. Now, when you set up a limited partnership, I set up a limited partnership about 6 months ago, where there's two owners, but we also, when you set up a limited partnership, you have to have a general partnership. Okay, you have to have a general partner, excuse me. And so we set them up as a 49.5 limited partner. And we set up a 1% LLC, where the LLC 1% LLC acted as a 1% general partner. So that entity itself is liable and not those limited partners. Okay. Generally, these types of taxes are reported on the Form 1065. That is a separate tax return. Okay. And like I was talking about with me and Michelle setting up our own entity or partnership where there's $100,000 of income and it's a 50-50 split, I would report $50,000 on my personal return, and she would report $50,000 on her personal via a form called a K-1. That's part of the 1065. That's reported on your personal tax return. Some of the advantages are it's very simple and inexpensive. Out of all the ones that you have to actually register and set up, it's fairly inexpensive, and there's a shared commitment. Generally, when you set up an entity, most of the time, we're going to put, going back to the example of Michelle and I, usually let's say, hey, we're gonna start this company with $20,000. I'll put up 10K. She'll put up 10K. Sometimes that doesn't happen, but a lot of the times it does. Some of the disadvantages are potential joint and individual liability, depending on how you set it up. Unfortunately, I've seen some disagreements among partners. Sometimes partnerships are set up without partnership agreements. Believe it or not, it happens more often than you think. And unfortunately, I'm going through one right now with one of my clients, one of my bigger oil and gas clients, where he tried to basically run into some issues with his partner. He offered to buy his other partner out for a significant amount of money. The partner turned it down. There's no legal paperwork. And so now both sides are drawing up attorneys to try and figure this thing out. And so always tell people, when you get into these types of either partnerships or LLCs where there's multi-members, you definitely need to get things inked up from a legal perspective in terms of buyout clauses, things if somebody passes away, what's going to happen there. Obviously, you share the profits and loss. That could be a disadvantage. That could be a disadvantage, depending on how you look at it. But a lot of the times, one person in a two-person partnership, Michelle. In a scenario with Michelle and I, Michelle's probably the person that goes out and markets because she's got such a good personality and goes out and gets business. And I'm probably the numbers guy behind the scenes. So in a scenario like that, it works out very well. Okay.
Ed, I'm sure we would never have any disagreements if we
I would agree with
together,
that,
right?
That's correct. I've known Michelle now for a few years now. Her and her husband have become some of my good friends. We've traveled over the course of the past 2 years. So I just use Michelle as my scapegoat in some scenarios. So. Again, if anybody has questions throughout this presentation, just feel free to chime in. So let's talk about what a limited liability company is. These are the types of structures that you're being hearing more of. it's fair. When I say it's fairly new, it's probably something that's become more popular over the past 20 years. And it is a hybrid of both a corporation and a partnership. Now, one of the structures that you're not going to see in this presentation is a C corporation. And I generally don't recommend C corporations to small business owners. And under very few circumstances do I recommend a C corporation. The only times I really recommend a C corporation if you're going to build your company up to sell it to like a big company like a private equity group, or let's say a scenario where your family household has significant medical expenses and you can actually pay your medical expenses out of a C corporation. But for the purposes of this presentation, I've elected not to include C corporations, but a limited liability has a hybrid of corporation and partnership. Okay. And going back to the beginning of the presentation, I said, when you structure a business, you have to look at two different buckets. One is the legal bucket and the tax bucket. Okay. Now, the limited liability, fairly, from a legal perspective, you limit your liability. It's pretty self-explanatory, but it could actually be very, very, a lot of people are trying to figure out what kind of tax structure to use in this scenario. You could actually be a sole proprietor filing as an LLC, which is where you still go back to the same tax ramifications of a sole proprietorship. Now you just have limited liability in that scenario. You could file LLC as a partnership, or you can file LLC as an S corporation. And I'll get into that specific slide after this. It's very easy to form and maintain, very similar to a partnership. Again, some of the advantages: limited liability, less record keeping, fewer restrictions, and it's several tax structures that you can choose from. You can be an LLC that files as a sole proprietor for tax purposes, as a partnership, S corporation. You can even see it as a C corporation. Again, I don't really recommend that unless there's certain scenarios where it makes sense. Disadvantages: state rules and state taxes. It's very, in Texas, I'm assuming most of the participants in this presentation are from Texas. Okay, in Texas, it's not as big of a deal for Texas franchise purposes. In Texas, I believe the threshold for owing Texas franchise tax, you have to have gross revenue of like 1.2 or 1.18, and that's before any expenses. In Texas, we don't have a quote unquote income tax. We have a gross revenue tax, and that they have these different types of deductions you can use. It's really an income tax, but they just can't call it an income tax in Texas. So in Texas, it's not so much of a disadvantage but it's something to consider if you're looking to set up in a different state. Okay, so this is S corporation. So I have about probably 300 clients total between business and personal. And out of those clients, 200 of them have separate business returns. In addition to and of those 200 returns, probably 150 of those are S corporations. They're either LLCs filing as S corporations, or they're corporations that have elected to become an S corporation for tax purposes. The other ones that are partnerships, they're probably the reason they're partnerships. They were either set up that way before they came to me, or maybe they have something like maybe they have an international partner which is prohibited in S corporation, or they have real estate. I don't recommend putting real estate in S corporation. Real estate's really good for partnerships or C corporations, but the vast majority of my businesses that have a separate business tax return, they're S corporations for a tax purpose. Okay, that you must meet the certain requirements and qualifications. Basically, you have to have 100 less than 100 shareholders. They have to all be U.S. citizens. You can't have anybody internationally. Those are some of the main criteria of the requirements and qualifications. And generally, most of mine, well, all of them have to meet those requirements. Now with this, you have to form and register at both the federal and the state level. Okay, so when you set up your entity with the IRS, let me backtrack a little bit. When a lot of people set up their entities, a lot of people like to set up with the IRS first and then the state. I actually like to do it the other way. And the reason I like to set it up with the state first is because I like to make sure the name is available with the state. So some people will pick an awkward name, and that's generally available. Sometimes they'll try to pick a more common name. And if it's available in the state, that's good. Obviously, it's not a big deal. But if it's not, then they're gonna have to go back to the drawing board and come up. So I always tell people like, hey, come up with 2 or 3 names. I'll check the availability of it. As a CPA, I have access to the Secretary of State, and I can check if the name is available. And if it's available, I'll go ahead and register it at the state level and then at the federal level. The reason I do the federal level last because you can have, Batinga CPA, 10 of them across the nation, but it's going to be assigned to my social security number. Whereas at the state level, they give you like a 9-10 digit number. So I always tell people to set it up with the state first to make sure it's available, because it's always going to be available at the federal level because it's going to be linked to either you or one of your partner's social security number. Okay. And like a partnership, it does flow through to each partner, very similar to what I explained with Michelle and our setup being 50-50. If you're going to set up an LLC, it's kind of a little cumbersome to become an S-corporation. You're going to have to first file as a corporation and then make an election to become an S-corporation. So it's a multi-step prong process in order to elect to become an S-corporation. But a lot of people, and to be honest, from my perspective, do I have that? Yes, it costs more to form as one of the disadvantages. And also from my end, it actually costs more to prepare from a tax return perspective because there's a lot of more disclosures. You have to disclose the balance sheet. It's just a lot more ticking and tying versus a partnership versus sole proprietor. Obviously, the tax advantages, tax savings, distribution versus wages. I'll talk about that here in just a second. And it has an independent life, so it can go on perpetually. It doesn't have to. One of the strict rules, you do have to have annual shareholder meeting. You have to take notes and adopt stuff, change stuff. So it's a little cumbersome on that, but it's generally not that big of a deal because most companies need to do that anyway. And so going back to the tax savings of distribution versus wages, and then a disadvantage of shareholder compensation requirements, reasonable compensation. So if you go back to a sole proprietor, so let's say you make $125,000 of net income as a sole proprietor, okay? All those earnings are gonna be subject to Social Security and Medicare, okay? So that's 15.3%, 7.65 as the employer and 7.65 as the employee, both half of that being Social Security, half of that being Medicare. Now, with an S corporation, one of the downsides in being an S corporation, you have to cut yourself a W-2 wage compensation. So for those of you who have worked before, so you have to actually pay yourself on a W-2 for a portion of your earnings. So in this example that I'm going to give you, I'm just going to use myself because I'm a PLLC. That's my legal structure. But the reason I get to add the P because it stands for professional. It's no different from an LLC. It's just because as a CPA, a doctor, an attorney, engineer, I get to add that additional alphabet letter at the beginning. And from a legal perspective, I'm still LLC, but I've elected from a tax perspective to be an S corporation. And why is that? One of the things on S corporation, again, is you have to pay yourself on W-2 wage compensation. So I'll give you an example. Let's say I make $150,000 of net income that I could pay myself, okay? Now, if I was a sole proprietor, 142.8 would be subject to Social Security, okay? And then the whole $150,000 would be subject to Medicare. There's no cap on Medicare, okay? I'll give you a really good example. I'll give you 3 good examples that I give these 3 examples every time I explain to a client what the definition of reasonable compensation and not what reasonable compensation is. So I have my biggest client. They're an oil and gas blending company. I think last year, even during COVID, I think they grossed about 82 million with a net of about 8 million. So in that scenario, since they're 50-50, they could pay themselves approximately $4 million a piece. Okay. Now, in their specific case, I only elected to pay them $250,000 in W-2 wages, and we took over $3 million out in distributions. Okay. Now, what's the difference between wages and distributions? Wages are subject to Social Security and the Medicare. Distributions are not subject to Social Security and Medicare. Okay. Those are the two big differences between distributions and wages. And going back to this disadvantage of reasonable compensation, in theory, this example, when I paid the two shareholders, they're both 50-50, $250,000 of reasonable compensation and gave them over $3 million of distributions that are not subject to Social Security and Medicare, it sounds very disproportionate, right? Like a lot of their pay is not subject to Medicare because they're over to $250,000, right? So they're going to be subject to Social Security no matter what. So they're going to be capped out at Social Security. But if they were to pay that all in wages, there would be no cap on Medicare. Okay. Now, if they were to go work at like a BP or Halliburton doing what they're doing specifically in an executive role, their base salary would be about $250,000. So that's my justification on only paying them $250,000 on salary, if that makes sense. And the rest of the distributions, they can just take. Okay. Hopefully that makes sense. In a scenario like myself, so like, let's say I make $150,000 net, I would probably pay myself somewhere between $90,000 and $100,000 on a W-2 and take the rest out in distribution, just to save myself some Medicare taxes and Social Security. And that's a way to do that as an S-corporation. Now, let me give you the opposite end of the spectrum on a client. This is before I started my practice in 2008, and this is an actual true story. So one of my client that came to us, they got audited by the IRS as an S-corporation, paying themselves wages. Okay, it was a orthodontist in the Houston area. He had the ability to pay himself about $350K on an annual basis, and 3 years in a row he took a W-2 for $15,000. So that's 1500. So the IRS obviously looks at that, and he took the rest out. He took over $300,000 out in distributions. And so the IRS looks at that as a way to skirt paying Social Security and Medicare, because there's no orthodontist in the United States of America that's going to work on an annual basis full-time for $15,000. Okay. So when the IRS looks at reasonable compensation, they look at, geographical location, they look at the type of industry you're in, and they look at what you have available to pay yourself. Now, this story didn't have a very happy ending, but basically we did our research and we proposed to the IRS, hey, look, based off this income, based off his specialty, we're thinking $200,000 is a very reasonable salary. The IRS said, hey, look, we'll meet you in the middle of $275. I told the guy to take the deal because he shouldn't have done it in the first place. If he would have cut himself maybe $150,000 salary, even $125,000, he probably would have gotten away with it. But because he made his salary so low, the IRS came to the conclusion that he was very egregious in doing so. And so when you do something very egregious like that, the IRS has the ability to come back and reclassify your distributions as wages. And that not only are you paying payroll taxes down that, income taxes, but you're also paying a 25% penalty for willful negligence. So don't do that. So those are the types of structures that we're talking about. We're going to go into some of these business deductions now. Again, if anybody has any questions, feel free to chime in, and Michelle can relay those questions to me. So always get, once you figure out what you're going to do, how you're going to set up a structure and whatnot, always get the question, what can I deduct? Okay. There's various ways to track your expenses. There's a lot of accounting software, QuickBooks, Sage, Peachtree. Some people just do it on spreadsheets depending on how, the volume of transactions they have. In terms of ways to track your expenses, I don't lean one way towards them. I've been doing this long enough to where I've seen it all. But I will say the record keeping is very important. Also, one question I asked is, should I maintain a separate bank account and or credit card separate from my personal expenses? And the answer is absolutely yes, because in the event that you get audited from the IRS, they're going to want to look at the bank accounts, are going to want to look at receipts and things of that nature. I think, and one of the important things from a business deduction perspective is presentation. And so that's some of the key considerations to think about from a business deduction perspective. So these are some of your basic business deductions that you guys would all know about: advertising, marketing, interests that are related to business credit cards and loans. Now, I know some people when asking on interest, I have some clients that have personal credit cards that are specifically used for business, or they may take a, unsecured collateral, unsecured, non-collateralized loan, personally for X amount of thousands of dollars and put it directly into the business and use it only for just business expenses. And the interest on that is deductible. You just have to be able to prove it and make sure, prove to the IRS that all those expenses that you use for the, on that personal credit card and on that personal loan were used for business expenses. Office expenses, your typical office supplies, postage, stamp, packing supplies, books, periodicals, continuing education type materials, dues and subscriptions. As a CPA, I have multiple dues and subscriptions angle, my CPA license, my QuickBooks licenses that I have for myself, just a ton of subscriptions, and those are deductible from a business perspective. Obviously, legal and professional fees, attorney fees. I always get the question asked if the cost for my tax returns, me preparing the tax returns, is a business deduction, and yes. So tax preparation fees, consulting, professional fees. Sometimes some clients, they'll get like a business coach or something like that to kind of help them out. And those expenses are deductible. I always get the question, gifts. Gifts are deductible, but they're actually limited to $25 a person. So you usually don't see the IRS auditing for something like that, but just be aware that gifts are limited to $25 a piece.
Hey, Ed.
Yes.
Going back one slide, you were talking about presentation is key. What do you mean by that?
Okay, it's a really, really good question. So when I do a tax return, okay, so if I'm doing a tax return, let's say it's a first-year client, okay, and let's say they had a prior CPA where I didn't necessarily agree with how they classified something, because marketing can be under advertising and some other expenses can be in different ways. I try to keep them in the appropriate bucket. Now, with that being said, let's say the prior CPA had like $20,000 in advertising, and this year it goes up to $40,000. Well, that's a big jump. I mean, when I do a tax return year to year, I do drill down on some numbers, but I look at it a comparative analysis. So let's say revenue went up 20%. Some expenses should go up 20%. Some expenses should go down 20%. It should be, fairly in line for the most part. Now, sometimes they're not. And so sometimes I have to ask that. So I'll say, hey, why did your advertising expense go up 50%, but your revenue only went up 10%? And they'll say, well, we made a conscious effort to like spend more on advertising to try and generate more revenue. Okay, that's fine, right? But in terms of presentation, I just like to make sure it's consistent from year to year, right? And so when I say consistent, I don't like expenses going up and down, fluctuating from year to year, unless there's a reasonable explanation for it. Because a lot of people are concerned about getting audited, and some of the things that the IRS looks for is their big fluctuation expenses from a percentage standpoint, right? And so that's one of the things like the software looks. When I say the software, the IRS software looks for is, okay, revenue only went up 10%, but marketing went up 60%. Maybe we need to look at that. Or their cost of goods sold in this scenario, in this industry should be 30%, but theirs is like 70%. Why is that? So I try to make sure when I do a tax return, obviously ethically, I try to make sure I keep them under the radar from the IRS by making sure expenses are presented in a way that they won't get audited. Does that make sense?
Okay, yeah. So basically you have to present it in a way that makes sense and the numbers back up what you're doing. And
right.
And
if they're in a scenario like, again, with the marketing where I can easily explain that on audit, okay, that's fine, no big deal. I'll go ahead and report marketing what it should be, but I may move it to a certain area just to maybe keep them under the radar. That makes sense?
Yeah.
Okay.
And then you were talking about here, I think.
Actually, I was talking about gifts.
Oh, gifts. Okay.
But actually, that's a really good question. Let me see. Let me fast forward a couple of slides to see if it's in there. No, it's not there.
No.
So
someone was asking if there's a cap on donations.
That's a good question. So it's a slightly loaded question. So I'll give you my example of what I personally do. Okay. So, I go to church and I put money in the offering plate. I obviously don't do that through the business because that's a charitable contribution. Okay. Now, with that being said, I get asked every year to sponsor something or whatnot. So every year I'm a golf hole sponsor for this one nonprofit that I'm a part of. Another one where I buy some gift baskets. Now, in that specific scenario, because I'm a golf sponsor, I'm getting like my name on the hole where it says Batinga CPA sponsored hole 13. That's actually an advertising expense versus a charitable contribution because you're getting your name on something. I'm getting my name on a hole. I'm getting my name in a program. That's actually an advertising expense because charitable contributions, true charitable contributions, like to a food bank or something like that, those actually go on, even though you pay through them through your business, they go, if you're a pass-through entity, that's a partnership or an S-corporation, they go on a separate portion of your K1 that gets in that when it flows through to your personal return, it goes under Schedule A as an itemized deduction and not as a business deduction. But going back to my example, as a business owner, I don't give any charities. I know that sounds really bad, but I mean, I do, but I sponsor stuff. I get my name on stuff. So I can use that as a business expense rather than it being potentially treated as a charitable contribution because charitable contributions are treated differently. They're not a business expense, even, but an advertising or marketing expense is actually a business expense and it reduces your order. So hopefully maybe that question or that answer helps that specific question.
Yeah, Sandy, if you have follow-up on that, go ahead and put it in the chat box and we'll cover that. One other question that has come up as we go through, if you could shed a little bit of light on nonprofit organizations, as your business, how does that change things? And maybe that's coming up later, but as we go on.
That question specifically, as the business owner, are they a nonprofit themselves? Or
yeah, they're talking about setting up a nonprofit.
Okay, so that's a little different. So in the state of, assuming you're in the state of Texas, I just set a nonprofit up probably 2 months ago. Setting up as a nonprofit, I hate saying it's simple, but not simple. So in the state of Texas, you have to have 3 board of directors in a nonprofit. Okay. And again, going back, I always set them up with the state first. Okay. So I set them up with the state first. And what I tell people about nonprofits, they're actually probably more complicated to set up because of all the rigorous paperwork that you have to do. You have to have, and to be honest, I have all the paperwork that you would need to set this up. And the neat thing is I can actually share this with clients because when you start a nonprofit, all that stuff has to be available for inspection anytime. Mm-hmm. So me giving you these legal paperwork, I actually had an attorney draft this up for one of her nonprofits. She ran a volleyball camp or something not camp, a volleyball travel league or something where it was a nonprofit. And all her paperwork is solid because she's actually a contracts attorney. So all her stuff is good, but most of that stuff has to be really well documented. You have to set it up. It's actually cheaper than setting up a business. It's cheaper to set up, but it's more rigorous to set up. You have to have 3 board of directors on the state and federal level. And so you're set up at the state level first, and then you set up with the IRS. So you actually have to set up the nonprofit as a quote unquote corporation first, but then you have to elect for a 501c3 status. And that's an additional cost and it's an additional step. And then it takes, if you're, depending on what type of revenue you're potentially going to be doing, if you're under $100,000 or you're projected to do under $100,000 in contributions, it's $250 or $275 to get the 501c3 status. And that takes 2 to 4 weeks to get actually accepted by the IRS. So from a step-by-step process, you got to set up with this. First, you need to figure out the name, and then you need to get your board of directors settled on. And then once I figure out who your board of director, your 3 board of directors are, you're going to set up with the state, make sure it gets approved by the state. Then I set up as an actual corporation with the IRS. And then once it gets accepted by the IRS, then I have to make the 501c3 status election. You have to file a 990-EZ with the IRS. That can be done online. And again, it takes 2 to 4 weeks. So Does that answer the question on the nonprofit? Or
Yeah. Thank you. Thank you so much.
Okay. So going back to gifts.
Oh, yeah, I'm sorry.
That's
We
okay.
interrupted your business. I need to know what else I can write off. Come on.
Everything. I'm just kidding. So other things, cell phone, only the business portion is deductible. Now, with that being said, my business cell phones, and I use it for personal, I just write off 100% of it because more than 90% of it's used for business. I text my kids and things like that. Something like that. Before the IRS would potentially audit telephone expenses, but they realized they were losing money auditing that type of stuff. So, even though I say rule of thumb, no more than 90%, I just write off 100% of it, to be honest with you, because the vast majority of my cell phone use is business. Travel, and now I'm going to get into another slide after this. I didn't realize it's 12:40, so I need to kind of scoot through these slides. Travel is 100% deductible, and some obviously for its business related. And this can include plane tickets, parking, tolls, rental cars, hotel. Okay, automobile expenses. This is a question I get asked a lot. Now I'm going to go back to this travel. Let me see, make sure. Do I have entertainment? For some reason, I did not include the entertainment expenses, but I will touch on that without the slide. So entertainment, before the TCJA, entertainment was 50% deductible. Now, technically, entertainment is non-deductible. And so I use this example all the time of what's potentially deductible, what's potentially not deductible. So let's say I take out a client to use in Texans game. Let's say, we meet at my office, we take an Uber to NRG. That is actually 100% deductible because that's travel, okay? Even though it's entertainment related. The tickets to the actual Texans game itself is actually technically not deductible under this new TCJA Act. But let's say we buy food and beer at the game, that's actually 50% deductible. It's really weird how this new rule for entertainment is being scrutinized, because I think the IRS has finally come to the conclusion that a lot of people use meals and entertainment more for personal fun than for actual business, which is not necessarily true, but that's kind of entertainment. Okay. I know I get a lot of questions on that very often, so I know you may have some questions on that. Automobile expenses. This is a big one I get often. So you can either use automobile expenses using mileage or actual expenses. If you're using actual expenses, and I'll get through this slide now, I'll go through some examples of why you may use one or the other. If you're using actual expenses, you can only deduct the business portion of the actual expenses. And again, now I have seen clients get audited for automobile expenses, and I've seen them get audited more for mileage than it is for actual expenses. Okay. And so for like automobile expenses, whether that include gas, repairs and maintenance, new tires, license, registration, it's more cumbersome to track actual expenses because you got to take a picture of the receipt, upload it somewhere, whatnot. And you're supposed to say, okay, I'm leaving the office to go to Michelle's office to talk about financial planning. And then on this date for this amount of hours. I mean, you're supposed to get that petty with it, but no one does. Okay, to be honest with you, I've never seen it. If you're using mileage, a lot of people use like a mileage book spreadsheet. There's a really good app that I recommend to my clients. It's called MileIQ. If you're one of those clients that don't care if your phone knows where you're at or where you're going, it's really good because it's really neat because you can have it on all the time and you can get, you can leave your house and then go somewhere. And let's say, oh, if you're there for more than 5 or 10 minutes, it's going to say, hey, we recognize that you've been stopped for 5 minutes, like swipe left for business, swipe right for personal. So it's really neat. And so it's really easy as long as you're not one of those people that is upset about your phone knowing wherever you are. The mileage rate for this year is 56 cents a mile. And that mileage rate includes, for gas, for repairs and maintenance, for general wear and tear. Okay. And a lot of people have said if they're going to use mileage, I always tell them to combine personal and business trips. Let's say you're going to a client on the way home, if you need to stop at the grocery store, stop at the grocery store. It's still a business expense because the main purpose of your drive was for business. You just happen to have a personal stop on the way home. So going back to do I pick mileage? Do I take actual expenses? If you're in an industry where you drive a lot, i.e. realtors, maybe like the nature of what Michelle does, she's a financial planner and she's going to and from clients, mileage probably makes sense. But if you're someone that doesn't drive often, actual expenses is probably better for you. So it just depends on what you're doing and how often you're driving. So obviously realtors over the past 18 months, or last year they didn't drive that much. Now I think they're starting to drive again. So mileage is still a very valid option or go-to option for those types of industries. Now I'm going to get into this TCJA. When it was passed under Trump, this is the largest overall in 30 years since the Reagan administration. And it was signed, like all tax law, is always signed like 10 days before the end of the year. So every administration, they do that. So liberal, conservative, they usually do this like 10 days before the end of the year. And it goes in effect, January 1st of the following year. So this TCJA portion, it doesn't expire to December 31st, 2025. Even though Trump is no longer in office, this portion of his tax law change is not set to expire. So just a couple of the changes, the patient protection that was under Obamacare, I think everybody knows this, that the IRS tax code is not, if you make $150,000, you're not in this tax bracket. It's a graduated income tax bracket based off, filing status, adjusted gross income status, and whatnot. So basically, tax rates dropped from Obamacare to Trump, and these are the tax rates as currently through 2021. Okay, and actually, Michelle and Meredith, I have like a handout for business and personal that I can send to you that you can forward to all the attendees that kind of like explains this more in depth.
Absolutely. We can attach that to the email we send out afterwards.
Because I'm sure everyone wants to read about tax law. So
yeah,
it breaks it down a little further. Basically, so exemptions were eliminated, but they raised the standard deduction, and these are the new standard deduction rates: 12.5 for single married filing separately, married filing jointly 25.1, married filing separately 12,000, head of household 18.8. Some of these, so one of the major changes is on the itemized deductions. Prior to the Trump administration, there was no cap on state taxes, property taxes. There's now a cap of 10,000. So that's that was a major hit for like high income earners, because a lot of my clients have multiple houses, and so they're only able to write off or itemize $10,000 of that. This mortgage interest deduction, basically, if you have multiple homes and your balances are over $750,000, there's a limit on mortgage interest that you can take. Some of you may be subject to that, some of you may not, but I do have clients where they have multiple houses where the combined or consolidated mortgage balance on those are in excess of $750,000. So their mortgage interest is minimized. Before, you used to be able to take these 2% miscellaneous deductions that are no longer allowed: tax preparation, unreimbursed employee expenses, certain investment expenses. Moving expenses used to be allowed, but now they're disallowed unless you're a member of the armed forces. Casualty losses only in federal declared disaster areas like the freeze, the hurricanes, things of that nature. Some of these miscellaneous items under the old tax law, once under Obamacare, once you reach a certain adjusted gross income level, your itemized deduction allowability would go down as a percentage based off of your adjusted gross income. And it would never go away completely, but it could get reduced up to like 50%, depending if you had adjusted gross income of $1 million or more. Before the Affordable Care Act, used to be penalized if you didn't have health insurance, and beginning January 1st, a couple of years ago, 19, the individual mandate for not having insurance was eradicated. So you no longer have to have health insurance, and you're no longer penalized for not having health insurance. The child tax credit increased significantly from $1,000 to $2,000. dollars. That went up with some of this COVID stuff that happened under Biden. I think it's up to about $3,600 now a child, but start phasing out a little bit once you reach certain thresholds. Oh, I didn't.
Oh, there they are.
There it is. The meals. I must have moved it incorrectly. So some of these meals and entertainment, prior tax law, like if you had an office party, that was 100% deductible. New tax law, those are still 100% deductible. Entertainment expenses, so tickets to sporting events, charitable events, concerts, and things like that, 50% deductible. Okay, now they're not deductible. Now, when I say charitable events, I know there's that question about charitable events. So if you're just like attending one of those things and you're like not as a sponsor, that would be considered entertainment expense. But it's like you're going there and you're going to buy $1,000 table, right? And you're going to get your name on the table as a sponsor, whatever type of sponsor. That's actually a marketing expense. So hopefully that sheds some light on that.
So Ed, that would go for like if you're at an event, like we did an event last weekend where we were a vendor, we had a booth at the Special Needs Family Expo. So that would fall under that.
That's a marketing expense, right?
That'd be marketing.
Right. So let's say before COVID, so I sponsored like going back to that golf sponsor. So like I got my name on a hole. Ed Batinga CPA is the whole sponsor of the 13th hole. That's a business expense. Now I went to a gala just to go to a gala, not as a sponsor, like just as an attendee. That's actually an entertainment expense. So that's not deductible. Now, if I buy something at one of those charitable events, that's actually considered a charitable contribution. So it's a little quirky. Anyway, so business meals, those are always 50%. It's still before and after 50% deductible. One of the things, meals for the convenience of the employer now versus before. So like when I used to work at a big CPA firm, because they would work us dog hours, like into late, they would buy us dinner, they would buy us breakfast and lunch on Saturdays and Sundays. Those types of expenses from the employer for buying us food back then were 100% deductible. Now they're only 50% deductible. So, but it's hard to really distinguish that because no one ever labels their accounting that way. So they just throw it on their meals and I'll just treat it as 50% deductible. So, okay, we're getting a little short.
Time check. It's a time check.
Yeah, time check. So I think this is the crux of the presentation, which I only left myself like 8 to 10 minutes. So I'm going to hopefully get through this. Now, this qualified business income deduction was probably the big thing that Trump passed under his administration. It applies to any of those forms that we discussed: Schedule C, Schedule E, SCorporation partnership. Okay, and this is actually a deduction that you get as a business owner. Okay, an additional deduction that you get, and it's up to 20%, reduces your taxable income, and it's contingent upon your filing status, your taxable income, and the type of trade or business. Okay, and I'll get into that type of trade or business here in a second. Okay. So without getting all into the wording of all this, basically, if they qualify what this thing is called a specified service trade or business, okay? And basically what a specified service trade or business is basically anybody that's like an engineer, attorney, a doctor, CPA, a financial planner. Those fall under this SSTB category, okay? If you fall under one of these categories, that 20% deduction can be limited and or eliminated based off your taxable income, adjusted gross income. If you're in a trade that's not one of these specified service trade or businesses, let's say if you're a manufacturer, you're a wholesale distributor, restaurant, something like that, that's not a quote unquote professional, then you're never going to be limited. We'll say never, you're never going to be fully eliminated from this qualified business deduction, okay? This is a really complicated slide. In 4 minutes, I probably shouldn't get into it, but the examples will probably be a little more, explain them a little better. But basically, depending on, it could be limited, and there's some tests you can do based off how much you pay in wages to all your employees and based on what you have in assets in the business, okay? So this is basically kind of like the threshold if you're in a certified specified trade or business. If you're not, There may be some limitations that makes them phase out. If you're in a certain, you get no deduction, and then once you get over a certain threshold, there's some testing that you have to do. Okay, that's basically that. Here's a good one example. So John, Jane, one's an independent contractor, one's an employee, one's married filing jointly. They're married filing jointly, and they have 2 kids, and they have itemized deductions. Okay. Here's basically under the prior tax law what they would make. Here's Jane's W-2 income, personal exemptions, blah 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 blah. Okay. After credits under the prior tax law, they would owe about $5,358. Now, under this new tax law, okay, they would only owe about $2,459. So they're saving, now they're in a marginal lower tax bracket, and their tax savings is about $2,900 based off this new law. A more comprehensive one. We'll skip this example. I think I got the numbers messed up. Look at this last example. There you go. This is probably one that fits more to a majority of my clients. So let's say Jane Doe, okay, she owns a consulting company, SCorporation, right? She pays herself $80,000, and she pays her employees a total of $50,000, okay? After paying herself and after paying her employees, the net income from the business is $370,000. Now, I'm not going to get into the depreciable assets of all this because this is a one test that you have to factor in. But, let's say her husband stays at home with the kids. They do filing jointly. They don't have any kids. So these are their itemized deductions. They have property taxes, mortgage interest, and charitable contributions. Okay. Now, under this prior tax law, okay, she would owe about $113,000. Okay, so that's $80,000 for her W-2 salary, $370,000 pass-through income because she owns the company 100%. Okay, personal exemptions, right? Because those are eliminated. Itemized deductions, but they do phase out once she gets past the threshold. Okay, taxable income about $419,000. Her tax is about $113,000. So basically, on $450,000 of gross income, she's paying about $113,000 of tax. And that puts her in a marginal tax bracket of 33%. But under this new tax law, she still has $80,000 W-2 salary, $370,000 of pass-through income. But now she gets this business income deduction of $65,000. Okay, and itemized deductions are not they're not phased out, or right. So now her taxable income is 415 versus where it's 418. So her taxable income is not that much lower than it was under the old tax law. But because of this business income deduction, it reduces her taxable income. Right now, her tax is only $75,000. So in this scenario, she saves a significant amount. Basically, she saves $37,600. Okay, it's the calculation over here to the right. I know none of you guys are really interested in the actual calculation, but under this new tax law, under the Trump law, it's very, very, very business owner friendly. Okay. So here's some of the Biden tax proposals I want to get out. I didn't talk about corporations, but under Trump, they reduced the corporate tax rate for C corporations to 21%. They're looking at, Biden was proposing to raise it to 28%. Now, the Senate Democrats and the House Democrats came out like 2-3 weeks ago and actually changed that to about 26.5%, and still fully phasing out that qualified business income deduction once you hit a certain threshold as a C corporation. So that doesn't really affect individual, but it does affect corporate owners like these big Fortune 100, 500 companies. So that's something everybody consider. Now, some of the individual proposed changes, he wanted to increase the Social Security wage base. So this year for 2021, it's 142.8. He had proposed raising the Social Security wage base to $400,000. I missed the zero there. So it's $400,000, which is the biggest increase in Social Security base raise ever that's been proposed. When the Senate Democrats and the House Democrats came out with some counter proposals, they actually were silent on this. So they didn't come up with a counter proposal. So I don't know if this one's still in play or not. For high income tax bracket, they're going to raise it from 37 to 39.6, and that was proposed from the Senate and House Democrats. Capital gain income is a big one. So clients have, either property, stocks, and bonds and things like that they can sell. Under the current tax law, the most you can be taxed from a capital gains perspective is 23.8%. It's contingent if you're on a high tax bracket. So it'd be 20% long-term, and then 3.8% for this net investment tax that had been implemented under the Obamacare. They had actually proposed raising that the long-term capital rate, if you're over $1 million of adjusted gross income, to actually making that the 39.6% tax bracket, plus the 3.8 net investment tax. So if you're selling property, like property or assets that appreciate in value, you were looking at basically, what is it, 39.6%, 43.4% on that type of stuff. Now the House and Senate Democrats came up, instead of 39.6, 25% plus the 3.8%. So you're still looking at a pretty significant rise in long-term capital gains. Minimum of 5% is what they're proposing. None of this is going to be voted on until the second or third week in December and be implemented January 1st. Now the TCJA, like the qualified business income deduction portion of stuff, that doesn't change. Okay, but these long-term capital gains and increase in the top tax bracket, that could change effective January 1st. One of the big things is this elimination of stepped up in asset basis. Now, I include that because we're talking about financial planning. We're talking about potentially estate planning. So what step up in basis? Let's say I was married. Let's say I bought an investment property for $250,000. Okay, and let's say I died, and the day I die, that house is now worth $700,000. Now, by law, that house passes to my wife on the date of death. Okay, but under the current tax law, she gets what's called a step up in basis to the fair market value of that asset on the date of death. So I bought it for $250,000. I die. The asset's worth $700,000. Her basis in that house steps up to $700,000. That goes the same with stocks. Goes the same with mutual funds. The recipient of that gets a step up in basis to the fair market value. Now, what the proposal is that, let's say I die, that my wife has to pay tax on that realized gain on asset appreciation from that house or the stock the year that I die. Now, the House and Senate Democrats were silent on that a couple of weeks ago, so I don't know where that's going in terms of the elimination of stepped up basis in assets. They're also talking about reducing the estate tax from 11.7 per individual to $5 million an individual. So those are just some of the tax proposals I just wanted you guys to be aware of. I know I had to kind of get through the end of this a few minutes ago. The last few slides a little quicker than I wanted to, so I apologize for that. But if you guys have any questions, please feel free to get in touch with me, Meredith, or Michelle. So I think you have a couple of slides that you want to go over yourself.
Yeah. I just wanted to, if you could go.
That's my information, and we'll pass this along to you as well. So I'll get this.
Yeah, that will be in the email. Well, and this whole presentation will be emailed out. Quickly, just about financial planning. We are a financial planning firm. We can help you look at a comprehensive financial plan that will help you get kind of like a roadmap to get you from where you are to where you want to be. Make sure that your goals are taken into consideration. We can talk over, do you have a will? Do you need one? Do you need a special needs trust or a third-party trust for your kids? Are your beneficiaries up to date? That's something you need to think about. We can go through annuities with you and discuss whether or not you might benefit from an annuity. You also want to think about, having these things in writing so that your family knows where all your information is if something were to happen to you, and communicating your intentions really with your family. We offer a free financial planning consultation. The first consultation is always free. you're all welcome to schedule that, and you'll be able to schedule through the email that we send. And then the last slide I have is just our contact information. And if you can flip to that last slide, you can contact me. My email address is mmorris@cpgcares.net. You can call me, follow us on Facebook and YouTube. And thank you so much, Ed, for being here and giving all this great information. And for everybody who joined us today. I know we lost some at the end there because they had to go, but we appreciate you being here with us today. Thank you, everybody. Bye-bye.